The Bank of Canada just held interest rates steady at 2.25%, telling us the economy is resilient. They're pointing to 2.6% GDP growth last quarter and an unemployment rate that just dropped to 6.5% as proof that everything is going according to plan. But that does not feel like your reality. While officials in Ottawa talk about a strong economy, a recent Angus Reid poll shows that the cost of living is the top issue for 3 out of 5 Canadians. You're feeling the squeeze at the grocery store. You're dreading your mortgage renewal, and you're seeing red flags the official reports are missing. Most Canadians under financial pressure think things will only get worse in 2026. So let's break down the huge disconnect between the headlines and your bank account as we head into 2026. This isn't just about data. It's about why millions of Canadians feel like the system is completely failing them. On one hand, you have the Bank of Canada story, cautious optimism. After 4 rate cuts in 2025, they hit the pause button. Governor Tiff McCallum says that 2.25% rate is the right to keep inflation near the 2% while helping the economy adjust. They see decent job reports and spending as a sign of strength. But then there's your story. It's that feeling that even though you're working way harder, your paycheck does not stretch as far. And it's the stress of living in a country with the highest household debt to income ratio in the G7. For every dollar of disposable income, Canadians now owe $1.75. This isn't a small gap in perception. While the bank sees a system that's adjusting, a lot of people see the system that's breaking. First, let's talk about jobs. The bank is celebrating a headline unemployment rate of 6.5%. Sure, a drop sounds like a win, but that number hides a grim secret. The November job report boasts about 54,000 new jobs, but most of those growth was in part-time work, for every person counted as unemployed. Countless others are underemployed, stuck in a part-time job where they need full-time hours, or working gigs below way their skill level. Plus, the official rate doesn't count discouraged workers, people who have just given up looking for a job entirely. Even the Bank of Canada admits that hiring is subdued. And that trade-sensitive sectors remain weak. For a while, press release celebrate on this number, the reality for millions is stagnant wages and precarious work. Second, this so-called strong economy, that 2.6% GDP growth in the third quarter of 2025 made headlines, but it's a number that masks what's really going on. That growth wasn't from a boom in Canadian prosperity. The bank's own reports show final domestic demand, what you and I call actual spending, was basically flat. The growth came from a weird shift in trade patterns and a huge 82% jump in government spending on weapon systems. The bank is already warning that GDP will likely be weaker in the fourth quarter. Forecasts for 2026 predict GDP growth of only around 1.4%, and that is if we avoid a major trade dispute. This isn't a robust economy, it's an economy on tight ropes. This all leads to your wallet. The bank says core inflation is around 2.5%, near their target. But that feels like a bad joke when you're at a checkout aisle. While the overall rate is down, prices for essentials like food and housing are still painfully high. And this is happening while Canadians are buried in debt. The household debt to income ratio climbed again to 174.9% in the second quarter of 2025. That means for every dollar of disposable income, we owe $1.75. For households led by someone between 35 and 44, the ratio is a jaw-dropping 254%. Now, the mortgage renewal crisis is hitting. Roughly 60% of all mortgages are renewing in 2025 and 2026. A homeowner with a 5-year fixed mortgage is renewing. could see their whole payments jump by 15 to 20% that can add hundreds or even thousands to your monthly bills. This is the reality that inflation numbers don't capture. If you need to sell your house or condo, give me a call at 416-845-9872. If this breakdown is making sense and you want to stay ahead of this pain, make sure you hit the subscribe and hit the notification bell. I put out videos like this every week to give you the real economic picture. Finally, let's talk about the storm the Bank of Canada acknowledges but doesn't convey the full dangers of. The 2026 USA-Mexico-Canada Review, the United States-Mexico-Canada Agreement. The backbone of North America trade is up for its first formal review mid-2026. This isn't a simple check-in. The current U.S. administration has made it clear it sees tariffs as a primary tool and has threatened Canada before and is still threatening. There's a chance the deal could be completely blown up or dramatically changed, which would be a catastrophe for our export and our economy. Key sectors like auto, dairy, lumber, and steel are all on the table. This uncertainty is already putting a chill on business investments, which threatens job creation and growth for 2026 and beyond. While officials use calm language, Canadian workers are bracing for a potential tidal wave. Look, the point of this isn't to scare you, it's to prepare you. When it feels like a big institution are out of touch, the only answer is to build your own stability. First, build your financial fortress. Your number one goal should be to have 3 to 6 months of essential living expenses in an emergency fund. This is your shield against a surprise layoff or a huge bill. Second, slay your high interest debt. With the Bank of Canada on a pause, this is your moment. Credit cards, debit cards, personal loans, every dollar in interest is a dollar you can't use for your own security. Get aggressive and pay down anything with an interest rate over 6%, 7%. Third, diversify how you make your money. In an economy, precarious work relying on one paycheck is a huge risk. Think about freelancing, a small side job, or a part-time work. This isn't a huge hustle culture, it's a practical defense. Finally, create a budget based on your reality. Forget the official 2.5% inflation number. Track the actual spending on groceries, gas, and housing. Figure out your own personal inflation rate and plan accordingly. This is how you take back control. There's a deep disconnect between Canada. The Bank of Canada is pointing to a resilient headline numbers, but the lived reality for millions is financial stress and job anxiety. The 6.5% unemployment rate is misleading, GDP growth is fragile, our household debt is a time bomb, and a massive trade storm is gathering for 2026. You're not wrong to feel like the official story doesn't match your life. The number actually confirms what you're experiencing. The goal now is to arm yourself with the knowledge and the discipline to get through the uncertainty ahead. Let me know in the comments, are you feeling this disconnect? And if you found this video valuable, please share it. Thanks for watching. Until next time, see you soon.